Hello, dear algorithms traders. In today's article we are dealing with the question of the extent to which the stock markets are manipulated. What specific conspiracy theories are there and what is the truth behind them? With today's video we begin by taking a closer look at how the big players work. Since this topic is very extensive and important, just one video is not enough. For this reason, a complete video series was created that will be extremely exciting and interesting. It was February 21, 1814 at 1 a.m. when the door of the ship Inn in Dover was suddenly thrown open and a Bourbon officer, apparently very exhausted, stormed in. He had just sailed over from France and had the biggest news of the last 20 years with him. He then asked for ink and paper and wrote a letter to the Admiralty in London with the happiest news. Namely, Bonaparte was captured by a group of Cossacks. And they slaughtered him immediately. The news of Napoleon's death made the rounds. People reacted with relief and the markets were euphoric. But when the fraud was exposed, Napoleon would not die until 7 years later. It became clear what was behind it. The alleged officer and his cronies had previously bought British government bonds and made a profit of £500,000. That would be the equivalent of £50 million today. The conspirators were prosecuted. Their act set a legal precedent and went down in history as the largest stock market fraud. An image shared on Twitter caused brief panic on the stock market in May 2023. Minutes after the publication, the weighty S&P 500 stock index fell by 30 points, which corresponds to a market capitalization of around $500 billion. But just as quickly as the price fell, it recovered. Because the explosion never happened. The image was created using artificial intelligence and widely shared on social media. Fraud does not always have to come directly from the stock market environment. Let's look at which fraudsters are possible on the stock exchange. It is rather unlikely that a retail trader would cheat himself and lose in 90% of cases. That is why we can rule that out. Trading, coaches, friends and acquaintances as well as meaningless videos on YouTube are largely responsible for the losses of retailers. A major danger is of course the broker, who may stage an internal stop fishing to make a lot of money. The danger here is primarily with the market makers, who can be avoided by using an STP or ECN broker. Then there are the various liquidity providers or data feeds as potential fraudsters. These providers help to bring the orders to the respective stock markets and are of course more in the focus of the supervisory authorities. Minor irregularities can immediately lead to a license being revoked, so irregularities are less common in this area. The Central Monitoring Body (EBS), which oversees the foreign exchange market, as well as the various stock exchanges around the world, cannot afford irregularities either. Therefore, we can also rule them out as fraudsters. The greatest danger still lies with the market participants and specifically with the big players. In terms of turnover, retailers account for just 5%, institutional traders for 10%, and the big players clearly dominate the market with 85%. For this very reason, I can understand why the big players conceal their intentions, because after all, we are talking about millions of dollars that don't even belong to the banks. When we used to play hide and seek, we didn't voluntarily shout that we were in the closet. Can you still remember which market orders mainly move the market? It was precisely the stops placed by retailers and institutional traders. Which limit orders can hold up the market massively? It was precisely the synthetic iceberg orders. And these two types of orders are invisible to us retailers. How should we react to something that we can't even see? Basically, you can assume that 95% of losses are the responsibility of retailers themselves. This is simply because a lot of mistakes are made during the trading process, which cost the retailer a lot of money. In the end, it's just a lack of experience that you can compensate for over the years with a lot of screen time. Let's look at an example. We see a price moving downwards, suddenly the downward movement accelerates, then an equilibrium is created, and the price is now pushed up more strongly. What is happening here? First, we draw a dome next to the candles. After the price has moved downwards more strongly, massive short traders enter the market within the equilibrium, and their stops are placed above the equilibrium. Short stops are market buy orders that the big players can intercept with limit sell orders. What do you notice about the limit sell orders? Well, probably nothing, because in principle everything looks normal. What we cannot see are the hidden iceberg orders that lie behind the limit orders. If the big player did not hide this iceberg order and placed it on the market as a limit sell order, it would look something like this. I think everyone knows that an iceberg order is the much better choice here. There is still a small problem, however, because there are still around 200 lots in front of the iceberg orders that need to be cleared. The big player has therefore previously placed a few limit sell orders, which he now only needs to delete. Next, the big player's algorithms shoot market buy orders into the market, and the stops do the rest. Most of the stops are now in a queue waiting to be executed. They are now being executed one by one, while the iceberg orders are gradually being reduced until the price jumps up a bit. The big player was now able to collect a total of 480 lots per dollar at level 1.10140 at an even cheaper price level. He has therefore bought 480 lots cheaply, the short traders have been stopped out, and at the same time long traders have been attracted. An optimal time to push the price down further. A normal process that repeats itself many times a day. Now we come to the important question of whether the big players are actually given preference when it comes to order execution. The answer to this is initially strange. Let's start with the answer, no. Transparency and equal treatment of all market participants is the most important principle of stock exchange trading. It is very strictly regulated by EU regulations and the Stock Exchange and Securities Trading Act. So, the stock exchange does not give the big players preferential treatment. Now let's look at the yes in the answer. We all already know the power of iceberg orders, which have a small, unidentifiable tip. Underneath there is usually a larger order block, which is automatically submitted as soon as the upper tip has been removed until the entire iceberg order has been processed. We differentiate between native and synthetic iceberg orders, whereby the latter cannot generally be identified by any stock exchange program. Between the tip and the iceberg tranches behind it, other market participants can of course enter at any time. As soon as the iceberg tranches behind it come into effect, there is almost no way to get in between because the fill happens within a few milliseconds. This means that all market participants who work with synthetic iceberg orders have a clear advantage over the other participants. And first and foremost, only the big players can work with these iceberg orders because they have enough capital. And these iceberg orders are a decisive force that is invisible to our eyes. Many conspiracy theories claim that the big players have formed a secret consortium. In the Euro-US dollar, there are 1 million retail traders, 10,000 institutional traders and around 100 big players, who of course are not always in the market at the same time. And this is how the distribution of market participants looks. Of a profit of $400 million, the retailers get 10 million, the institutional traders 90 million and the big players 300 million. And here we see the percentage distribution of the profits. 99% of the market participants receive 2.5% of the profits, while 1% of the participants receive 97.5% of the profits. This is an uneven distribution. So, are the big players joining forces to push the market up or down together? Well, you don't need to, because the big players know their own approach and can therefore see immediately whether their colleagues are buying or selling. Accordingly, they can join forces and push the market up or down together without having agreed on it beforehand. In addition, they have different strategies that are not always entirely legal. One example of unauthorized cooperation is a currency swap where two different banks interact with each other. We have already discussed this in detail in some videos. In addition, there are other procedures, some of which are prohibited, and which have been adopted by the well-known high-frequency traders. Regardless of whether the bank provides itself with liquidity in a currency swap or a second bank is involved, in both cases it is prohibited insider trading, which the supervisory authorities are very interested in. If a supervisory authority wants to see the bank's documents, it must expect that this could mean several container loads of paper. And everyone can imagine the work behind it. Access to data does not necessarily help the authorities either. Of course, the supervisory authorities generally monitor whether insider trading is taking place, but with millions of transactions it is almost impossible. And when such insider trading is uncovered, the banks are often only subject to ridiculous fines. We already know this from the past. Banks have different, spatially separated trading floors where different transactions are carried out. The interesting transactions take place on the executive trading floor, such as unauthorized currency exchange transactions, proprietary liquidity models, or the unauthorized ping-pong strategy. Traders who are in this narrow circle earn so much money that they are set for life and cannot change jobs because they are banned from working for at least 10 years. They also face millions in fines due to special confidentiality clauses. By now it should be clear to everyone why there is hardly any information about the big players and their practices. The companies shown here work seriously and are only intended as example. For us retailers, the Forex market is much more difficult to see than for the big players, as they even sell volume information to institutions. This means that the big players can see what the retailers are trading. If the retailers are long, the big players are short. If the retailers are short, the big players go long and fill their limit orders with the retailers' stops. But we retailers can defend ourselves. On the left-hand side we can currently see all incoming market, sell and market buy orders. With a little trick, you can use the gaps in the cumulative big player orders to make the incoming retailers visible. This makes it easier to identify stop zones. Trading coaches tell us that the futures market is easier to trade than the Forex market. But that's a big lie, because both markets are equally difficult to trade, but the difference is in size. Over $8 trillion is traded daily in the Forex market, which is 20 times more than all global stock markets and 20 times larger than all global futures markets. The euro-US dollar in the Forex market alone is 6 times larger than all global futures markets. And let's ask ourselves which tracks are easier to locate in the market. The answer is simple: the tracks of the largest market participants are the easiest to read. Look at the euro-US dollar as the largest asset in the Forex market, and the S&P in the futures market. Here, the euro-US dollar is the biggest in terms of turnover, and here the S&P, which is comparable to the US dollar Polish zloty, by the way. This means that the biggest big player who trades daily in the euro-US dollar could trade the S&P future twice a day on his own. And that means that there are unfortunately no really big players in the futures market. In the Forex market, only the big players move the markets, and in the futures market, the smaller institutional traders. That means that in the Forex market, it is much easier to identify the big players than in the futures market, the institutional players. Another challenge is spoofing, both on the limit buy and limit sell side. There are different approaches here that confuse us retailers. The trick is to use spoofing to get from the lie to the truth. I have already provided you with a tool for this, which you can download from my blog at Forex Factory. What ultimately makes a big player? They have strategies and approaches that are reserved for us retailers. This gives the big players a clear advantage over us retailers. But the big players also have weaknesses that give us retailers an advantage, provided we use these advantages. David versus Goliath was also an unequal fight, which David was able to win with the help of a slingshot. And we retailers can also win with a slingshot if we know exactly how the big players operate. And that's exactly what we'll be looking at in the next videos. I'll keep my fingers crossed for you and look forward to seeing you here again soon. Best wishes, Michael.